Subscribe to LearnCab and hit the bell icon to get notified.
Yes, guys. So today's session, we are going to discuss about something called as IND AS 33. Now, this is a very peculiar standard because IND AS 33 deals with something called as earnings per share. Now, when I call about this concept of earnings per share, the first thing that I want to bring it out is that this standard is purely a presentation and disclosure standard. You don't recognize earnings per share. Now, earlier, whatever asset related standards or liabilities related standards that we have discussed, we were always talking about the point of recognition and measurement. Here, you don't have recognition at all because I don't recognize EPS. EPS is not an asset or a liability or a debit or a credit to be recognized in my books of accounts. So it's purely a presentation and a disclosure related standard. So all that you do is that EPS of a particular company is so and so is what I presented, and the way I've computed it, the way I've calculated this part of EPS, I will disclose it as a part of my notes to accounts. In simple, this is all that we do. Now, why is this standard so important then? I'll tell you one simple logic that today, when you see your stock markets are, either on a bear trend, sometimes on a bullish trend, you find that stock market immediately after the COVID news has broken out, it came down to 7,500, your NSE, and today you see it at 15,000 plus. So if you look at the stock markets have actually doubled in the last 8 to 10 months, or I put it as 10 months. In the last 10 months, the entire stock markets have actually doubled. So that means you need to understand that there is a certain movement in the stock prices. Now, why is this certain movement in the stock prices arising? Your Sensex, I'm not talking about an SFM class at all. I'm purely talking about financial reporting, and I'm trying to emphasize upon the importance of EPS there. Your entire stock market revolves around the principle of P into EPS is equal to market price per share. So any market price per share either derived in an NSE or a BSE is calculated using the same formula of EPS into P. Now, generally you find this trend happening that whenever a quarterly results of a listed company are out, you find that there's a huge volatility as far as the stock market movement is concerned. Let's say ICICI Bank has released its quarterly results or Q3 results on a particular day. Now, any Q3 result or any quarter result should be declared within 40 days from the end of that quarter, according to SEBI. That is a listing agreement of SEBI. So 40 days in the sense, let's say 31st December is your close of Q3. That means the results will be declared by 10th of Feb. So when I'm declaring the results on 10th of Feb, what really happens is, it is the EPS which changes because your earnings per share is based on your past quarter result. So that is your result from October to December, that is a Q3, and this Q3 result, whenever it fluctuates, wherever the EPS goes up or the EPS goes down, the same movement is actually reflected even on the price of the share. Yes, I am assuming that the PE is constant, which is not right because PE keeps moving, but to explain the significance of EPS, I am assuming that the PE is constant. You remember diminishing marginal utility, everything else remaining constant. Now, I'm only asking you to keep one PE constant, so I think my explanation is justified. So, EPS is so important that every quarter results are out, you find that the stock market moves around. The stock market is moving because of the multiplier of EPS. Because your market price per share in a stock market is derived by multiplication of EPS into P. So, this simple formula of market price per share actually gives a lot of emphasis on the EPS as well. Though on today's day, markets are more revolving around the PE movement of a company, but EPS is also a significant metric in measuring the market price per share. So there we understand that EPS is important. What else makes EPS so important? EPS is also important to measure the progress of the company compared to the previous year. Now, let's say, for example, I have written a particular mock test and I've scored 75. Now you tell me good or bad. How do I know whether good or bad? How much is it out of? It is out of 100, good. It is out of 200, bad. Out of 100, okay, good. Last time I got 90. Now good or bad? So always there is a comparison. Let's say last time I got 60, now I got 75. Now good or bad? Good. Okay, fine. The classroom average is 95. Now good or bad? Bad. So that means one single metric by itself, you cannot declare whether the results are proven to be good or bad. For example, 50 in CA is difficult. 50 in the same 10th class is not so difficult. So that means the comparison also should be on par. So it should always be between two peers. So EPS creates a single platform or a metric to be compared. I walked for 1 kilometer. What are you talking? I walked for 1 mile, which is more. Now they are not comparable terms. So a mile has to be converted into a kilometer to prove that a mile is more than a kilometer, and therefore 1 mile is greater. So a person who actually walked for 1 mile is more than the person who just walked for 1 kilometer. So how do you know about this? That means they are bringing two particular individuals' achievements on a single scale of measurement to prove which person has actually fared better. Such single metric is called as EPS as far as your companies are concerned. What is EPS? An earnings per share which is calculated on a periodic basis. If it's a listed enterprise, I normally calculate on a quarterly basis. If it is an unlisted enterprise, then I generally calculate it on an annual basis. Now, this way, whenever I talk about EPS, EPS is not only important for determining market price per share, but it also helping comparison. Comparison between what? Comparison with my past performance or benchmarking with my competitors. I can try to identify whether I am performing fairly well or not. Clear? So EPS is becoming such an important metric. Now, when I talk about EPS is so important, so important, so important. Now, fundamentally, where did I even touch about your IND AS 33? I'm just emphasizing upon the importance of EPS, but let us look at what EPS talks about. This standard IND AS 33 particularly divides EPS to be presented and disclosed into two parts. That means each enterprise has to disclose two EPS. First EPS is called as basic EPS. Second EPS is called as diluted EPS. These are the two EPSs which should be presented and disclosed as a part of your financial statements. Now, what is this basic EPS? What is this diluted EPS? Is the entire discussion that we'll be going about. The first part of our lecture, we'll only be discussing about basic EPS. The next part of our lecture, we will be discussing about diluted EPS, which is one of the most brilliant concepts that can ever be produced. So, what is this basic EPS and diluted EPS actually talking about? Let's get into the concept. So like I told you, the movement of share prices is based on your EPS, your comparison with previous year, and your comparison with industry benchmarks. Everything is possible only with the EPS. And like I told you, EPS is of two parts, basic EPS as well as your diluted EPS. First, let's concentrate upon basic EPS and look at the formula that he gives. Basic EPS, or in short you call it as BEPS, is computed by using a formula of PAS by WANES. In short, I call it as pace by veins. Okay, so pace by veins. What is pace? Profits available for distribution to equity shareholders. And veins is nothing but weighted average number of equity shares. Saying pace is profits available to equity shareholders, and veins is nothing but weighted average number of equity shares. First, before we get into the complex computation, let me concentrate first of all on what is this PAS and what is this WNES. Forget about basic EPS for a second. Let's try to concentrate upon how to derive this numerator and how to derive this part of denominator. How do I calculate numerator? How do I calculate denominator? So let's break it up. First, I will take up PAS, that is your numerator part. Then I will come to your denominator, that is your weighted average number of equity shares. Pace is one of the most easiest. Veins is a slightly tricky one. Slightly tricky. I'm not saying very tricky, but slightly tricky. So let's start with the first part, that is the numerator part. How do I calculate this numerator? Profits available to equity shareholders. Now, what is the amount of profit available to equity shareholders? The profit available to equity shareholders for payment of dividend or distribution of dividend is such kind of profit which is after payment of interest, after payment of tax, and after payment of preference dividend. So after discharging the liability of preference dividend to the preference shareholders, balance profits, if any, they are left out, then I will get something called as profits available to equity shareholder. So in a simple formula, I can put it up like this: profit after tax as per your P&L reduced by the amount of preference dividend, which is not debited to the P&L because it is a appropriation of profit, should be considered as my profits available to equity shareholders. So I'll repeat again. I'm saying profits after tax minus preference dividend is equal to profits available to equity shareholders. Now, profit after tax, how to determine? I leave it to you because you have concepts of accrual, you have concepts of matching, you have concept of conservatism. All these principles applied into your, in preparation of your statement of profitability. You have multiple standards which will talk about it. Revenue recognition standard deals with IND AS 115. Borrowing cost dealing with IND AS 23. Your forex gain or loss dealt by IND AS 21. You have impairment dealt by IND AS 36. You have depreciation and amortization dealt under IND AS 16 and IND AS 38. So many components of P&L which we have already dealt with under multiple other standards. Taking that into consideration, I derive at something called as profit after tax. After applying your current tax and your deferred tax, which is a tax expense as per IND AS 12. So even that also considered, I will get profit after tax. Such profit after tax, I am not gonna discuss any further in this particular standard because multiple standards are involved into identifying this figure of profit after tax reduced by preference dividend. Now, this reduction of preference dividend, there are two types of preference dividend like we always know. One is called as cumulative preference shares and second one is called as non-cumulative preference shares. Now, what is the significance of both of them? Cumulative preference share means whether you pay a particular preference dividend in the current year or not, such amount of dividend is payable in the subsequent years whenever the company earns sufficient profit. For example, the company made loss in the current year and the company is unable to pay such amount of dividend. Such cumulative preference dividend will be accumulated to the subsequent year and will be paid off whenever the enterprise earns sufficient profit. But non-cumulative preference dividend is of an exact contrary. If there is insufficient profits in a particular financial year, then such amount of preference dividend is not carried forward. It is not necessary to be paid in the subsequent years. So the company or the enterprise does not assume a liability for unpaid preference dividend of a particular year. This is a peculiar nature of cumulative and non-cumulative preference shares. I know most of you, 99.99% of the people who are watching this already know what these are. I'm just repeating it. Now, what is the peculiar change which applies in computation of PAS? The peculiar change is this, that whenever I have preference dividend, to the extent they belong to cumulative preference shares, preference dividend has to be reduced from the profit after tax, whether you have sufficient profits or not. Whether the dividends are declared or not, I have to make sure that the preference dividend is reduced from my profit after tax. But in the case of non-cumulative preference shares, I will reduce preference dividend from profit after tax only if such dividend is declared. I'll repeat. On cumulative preference shares, I will reduce preference dividend from profit after tax to arrive at profits available to equity shareholders, whether the dividend in the current year has been declared or not. Why did you do that? Because anyway, the enterprise has a liability. If not current year, subsequent year, I'll have to pay that preference dividend whenever I make sufficient profits. When you assume going concern of the enterprise, I'll assume that the enterprise will live for a longer period of time, infinite life. So why does it have infinite life? Because I'm assuming that some point of time in future I'll make profit. Why do you think Flipkart was acquired by Walmart at such a high price? And it's a loss-making entity. Why did they acquire? Because they assumed that Flipkart can make profit in the subsequent years. That is fundamentally what we are talking about. Therefore, whether I have sufficient profits to declare dividend or not, whether I have actually declared dividend or not, I'll have to reduce the preference dividend every year from profit after tax to arrive at profits available to equity shareholders if the preference shares in the enterprise are of cumulative nature. However, if the preference shares are non-cumulative in nature, then it is not necessary for us to deduct the preference dividend from profit after tax to arrive at profits available to equity shareholders. Why is that so? Because if I don't have sufficient profits, the preference dividend need not be declared or paid, and even though they don't declare in the current year, there is no obligation for the enterprise to pay it in future when they make sufficient profits. That is the fundamental logic. But one more logic has to be inserted here. That one logic which has to be inserted here is the concept of cumulated preference dividend or arrears of preference dividend. The arrears of the past years, if the past year preference dividend was not paid, should I reduce again in the current year to make sure that I calculate for the computation of profits available to equity shareholders? Let's say your preference dividend is 100, cumulative in nature. Last 2 years I did not pay. Arrears of preference dividend is 200, shown as a contingent liability. Now I give you calculation of the numerator part, PAS. How do you calculate? Profit after tax minus 100 current year preference dividend, whether declared or not, minus 200 arrears of preference dividend. Should I reduce? Should I reduce arrears of preference dividend? I don't have to. Why don't you have to reduce it? I don't have to reduce it because every year, whether such dividend was paid or declared or not, I made sure that there was a deduction in computation of EPS. Therefore, those arrears which you are talking about, I've already considered them in that particular year for payment for a computation of EPS. Therefore, subsequently, when there is an arrears of preference dividend, it need not be considered in computation of your numerator, that is PAS. Therefore, the preference dividend to be reduced for computation of PAS is only the current year preference dividend. And if the preference shares are cumulative in nature, whether the dividend is declared or not, I will compulsory reduce preference dividend in determination of PAS. If they are non-cumulative in nature, I will reduce PAS from profit after tax only if such dividend is declared. Clear logic? Clear with this? Let's get into the last adjustment in PAS. Profits available to equity shareholders. Now read that concept. I'll tell you what exactly it means. Expenses and losses adjusted against reserves, which otherwise would have been debited to P&L, should be deducted from profit after tax in computation of PAS. I'll repeat again. I said expenses or losses which have been adjusted against reserves, which otherwise would have been debited to P&L, should be deducted from profit after tax in computation of PAS. Does it make any sense? Let me try to take you through examples. Now let's look at this. Let's say, for example, my profit after tax is, let's say, about 100. Okay. Let's say I had a certain amount of preliminary expenses to the extent of 5 rupees. I could have either written the entry as writing it off to P&L account debit 5 to preliminary expenses, or I could also write it off against securities premium. I have two options because securities premium can be utilized for adjustment of your preliminary expenses. So either of these two I could have adopted. I could have either gone as per the first model or I could have gone as per the second. Either I could have written P&L to preliminary expenses, or I could have written securities premium to preliminary expenses. Let's say, for example, this particular enterprise have issued shares at a premium. So therefore, there was a securities premium already existing under reserves and surplus. Therefore, this preliminary expenses got adjusted against the securities premium and have not been debited to P&L. Such kind of expenses which have been adjusted to reserve, here it is securities premium, which otherwise would have been adjusted to P&L, should be reduced in determination of PAS. Therefore, this should be reduced by 5 and 95 is your PAS for computation of EPS. For computation of EPS, I will consider it as 95. Sir, P&L is showing 100. I agree. But the P&L is showing 100 because such kind of preliminary expenses which should have been debited to P&L has now been debited to securities premium or adjust against securities premium instead. Such kind of expenses and losses which otherwise would have been adjusted to P&L should be reduced or should be considered in computation of PAS. Similar logic you have under IND AS 36 impairment as well. If you remember impairment logic, impairment of an asset, the impairment loss should be debited to P&L. Therefore, I should write the entry as impairment account debit to asset and P&L account debit to impairment. However, if the asset was upward revalued earlier, then in such case, there is a revaluation reserve already existing and such impairment loss should be written off against revaluation surplus. So instead of writing P&L to impairment, I will write revaluation surplus to impairment. So if that revaluation surplus was not there, this impairment would have been debited to P&L. So an expense or a loss which has been written off or adjusted against a reserve in the financials otherwise would have been adjusted to P&L, which otherwise would have been adjusted to P&L, should be adjusted or should be deducted in computation of PAS. Look at the examples that he gives. I gave you 2 examples already. So let's see the other examples. Impairment loss adjusted against revaluation surplus, preliminary expenses or loss on issue of debentures adjusted against securities premium. So in both of these cases, you can either be preliminary expenses or loss on issue of debentures or redemption of issue of debentures at a premium. Such losses can be written off against securities premium. So if there was no securities premium, I would have directly debited it to P&L. So which otherwise would have been debited to P&L should be adjusted in determination of PAS. Now read the sentence once again, it will make full sense. An expense or a loss which has been adjusted from a reserve otherwise would have been adjusted or debited to P&L should be deducted from PAT, profit after tax, to arrive at the computation of PAS. This is the logic. Here, this is the last adjustment as far as the numerator is concerned, that is profits available to equity shareholders. Now, that will bring us to the end of the discussion on the numerator part, that is profits available to equity shareholders, where we have seen particularly the formula of PAS is equal to profit after tax minus preference dividend. In determination of profit after tax, I gave you one adjustment. What is the adjustment which I told you? Any expense or loss which has been adjusted to a reserve otherwise would have been debited to P&L should be deducted in computation of profit after tax for determining PAS. I have given you examples for this. Regarding preference dividend being reduced, I gave you 2 cases. I said for cumulative preference shares, I will reduce the preference dividend whether the dividend is declared or not. Therefore, sometimes even if I don't have sufficient profits to declare preference dividend, I will reduce preference dividend in computation of PAS. However, in case of non-cumulative preference shares, I will reduce preference dividend for computation of PAS only if the dividend has been declared. Now, simple question before I go into the denominator is, can PAS be negative? Yes or no? Answer is yes. How can PAS be negative? No problem, man. Who said profit after tax is always a profit? There could also be a loss. So therefore, your PAT itself could be a negative figure. But let's say your PAT is a positive figure. Even in such cases, if your preference dividend on cumulative preference shares is more than the profit after tax, there is every possibility that your PAES could be negative. Profits after tax is 15. Cumulative preference dividend is 50. Then what will happen? Your PAES is minus 35. Therefore, there could be possibly a negative figure if in case your preference dividend is more than the amount of profit after tax, in case those preference shares are cumulative in nature. Clear? So there could possibly be a case where a PAES could be a negative figure, either in case your PAT is negative or in case your PAT is positive but is less than the amount of dividend on cumulative preference shares. Clear? Now, if I go with the earlier formula that we have seen, what is the formula of EPS that we have seen? PAS divided by WNES. Profits available to equity shareholders. If the numerator itself is negative, then there's every possibility that your EPS is also negative. Yes, your EPS can definitely be negative. So therefore, in some situations, you might come across enterprises which has a negative EPS. All famous companies that you find around the world, Uber, Amazon, Flipkart, all these people have been reporting a negative EPS all throughout in their life. Okay, so these companies have not come into profits yet, but they have a potential of earning profit. That's why you find that their market prices are high. Okay, so fundamentally, I can tell you one simple logic that there could be a situation where an enterprise could report a negative basic EPS. Now let's come into the denominator part, that is WNES, weighted average number of equity shares. How do I calculate this denominator part, that is weighted average number of equity shares? Simple logic. Number of shares outstanding at the beginning of the period. Number of shares outstanding at the beginning of the period adjusted by shares issued or bought back during the period multiplied by a time weighting factor. I'll repeat what I said. I said number of shares at the beginning of the period adjusted by shares issued. Shares issued, what will happen to the number of shares at the beginning of the period will be added, or shares which are bought back. Therefore, the number of shares will reduce, minus. So plus or minus shares issued or shares bought back during that particular period multiplied by their time weighting factor. What is your time weighting factor? Time weighting factor is number of days for which specific number of shares are outstanding during the period divided by the total number of days during the period. So I'm saying a time weighting factor is number of days for which specific number of shares are outstanding during the period divided by the total number of days during the period. That will give me time weighting factor, TWF. This is my computation of weights. Clear? I said number of equity shares outstanding at the beginning of the period adjusted by plus or minus shares issued plus or shares bought back minus during that particular period multiplied by time weighting factor. Your time weighting factor is the number of days for which specific number of shares are outstanding during the period divided by the total number of shares during the period, or total number of days during the period. Let's try to apply this. Okay, let's try to apply this first of all. I hope you can see this question right up on your screen. I hope everyone can see this question right on your screens. Look at it. Now these are illustrations for IND AS 33, which were normally given by ICI to explain how the standard actually applies. So he is giving you a small illustration and saying that the balance at the beginning of the period is 1800. On 31st May, the number of shares issued for cash is 600. 1st November, shares bought back are 300. And finally, 31st December, at the end of the year, it is 2100 shares. This is a simple illustration given to you, and all that you have to do is calculate weighted average number of equity shares. I will calculate this in two ways. Okay, I will tell you what are the defects in each method, but I will calculate the same thing in two ways. Let's see. So I'm looking at computation of WNES, weighted average number of equity shares. So this is the first method and this is the second method. Let's see how I calculate. First method, okay? How many shares were there at the beginning? 1800. How many shares were issued after that? 600. How many shares were bought back? 300. 1800 shares over entire 12 months. When were those 600 shares issued? Those 600 shares were issued on 31st May. And when were they bought back? 1st November. So I'm talking about a calendar year, so be specific. 31st May, I'm talking about number of months starting from 31st May. So June to December, June, July, August, September, October, November and December, 7 months. 300 bought back on 1st November. 1st November, that means basically I'm only considering for November and December because it happened on 1st November. About 2 by 12. Calculate. This is 1800. This is 350 plus. And this is 50 minus. My answer is 2100. Same thing, I will try to calculate in a different way altogether. What is my different way? I'll come to that. Look at it. I had 1800 shares outstanding until 31st May, starting from 1st Jan. So 1st Jan to 31st May, that means for 5 months, I had 1800 shares outstanding. For 5 months, 5 by 12. After that, 600 shares were issued on 31st May. Therefore, the total number of shares became 2,400. So the number of shares were 2,400 starting from 1st June up to 1st November. 1st June to 1st November, another 5 months, this number, so and so number of shares were outstanding. After the shares were bought back, the number of shares came down to 2,100. And these many number of shares were outstanding for the last 2 months. So 2 by 12. Calculate and check. 1800 into 5 by 12 is 750. This is 1200. And this is 350. Total coming back to 2100. So I find that answer is exactly the same in both the ways. You calculate either in the first way or in the second way, my answer of weighted average number of shares is absolutely the same. But I'll tell you something. This part which I represented out here, this is wrong. Why is it wrong? Now go back to what the formula says. The formula is saying that number of equity shares at the beginning of the period adjusted by number of shares issued or bought back during the period. So first thing that there should be an adjustment for is the number of shares at the beginning should be adjusted by added by the shares issued or reduced by the shares bought back. Therefore, in a significant way, I can understand that this is wrong and this part is absolutely correct. However, I'll bring in with one more logic, man. Please try to understand. Even though this is right, this is wrong. How is this wrong? Look at what is your time weighting factors. Your time weighting factors, yes. So what are we looking at? We are looking at weighted average number of equity shares, and I told you that basically your time weighting factor is something which should be calculated in number of days. Therefore, number of days outstanding, a number of days for which specific number of shares are outstanding during the period divided by total number of days during the period is the most important thing to be looked at. So if you look at the calculations, I have missed out the calculation of time weighting factor. Had I considered time weighting factor in number of days, then this should not be 5 by 12 or 5 by 12 and 2 by 12, but it should have been calculated in number of days So divided by 365 or divided by 366. Now someone will come up to me and say, sir, what is that? It more or less will be the same, because the question which you showed us is almost coming up to the same logic, because the issue of shares has been either taken at the beginning of the month or at the end of the month. Therefore, it shouldn't have mattered much. That is exactly my point, where he says that though he is discussing about veins and gives a very specific definition, he also says that a reasonable approximation of veins can be considered as sufficient in most cases. So a reasonable approximation of veins can be considered sufficient. Since it can be considered sufficient, even a reasonable approximation, therefore in such kind of situations, you don't have to be bothered of how exact your calculation are. Because if it is a leap year, then my denominator should be 366. Non-leap year, the denominator should be 365. So all these logics you can forget. So therefore, he's saying reasonable approximation of veins is sufficient. Exact figure is not necessary in determination of weighted average number of equity shares. That will bring us to the end of discussion on veins, but there are multiple adjustment to veins. What are adjustment to veins? Partly paid shares, shares with different nominal value, right? Number two, there can also be a situation where I have bonus shares, where I can have right shares. So these are the three fundamental adjustments that we'll be looking into veins. Now, when I look at the adjustment of veins, I have to be very careful. The first adjustment, partly paid shares or shares with different nominal value. What happens when I have different nominal value shares? When I say different nominal value, that means basically I have 100 10 rupee shares, I have 100 5 rupee shares. Different paid up value. 100 10 rupee shares fully paid up, 40 10 rupee share 8 paid up, 60 and 10 rupee share 4 paid up. So this way I can have multiple paid up values also. Whenever I have multiple paid up values or multiple nominal values, then the right way of calculating veins is by considering an equivalent number of shares. How do I calculate this equivalent number of shares? Very simple, guys. When I tell you equivalent number of shares, equivalent number of shares is equal to equivalent number of shares of rupee X each. I can find equivalent number of 10 rupee share. I can find out equivalent number of 5 rupee share. Whatever you want, you can calculate by using this formula. Total paid up value on shares divided by X. So if I want equivalent number of 10 rupee share, I'll divide it by 10. If I want equivalent number of 5 rupee share, I'll divide it by 5. If I want equivalent 100 rupee share, I'll divide it by 100. This is the formula which I will use to calculate equivalent number of equity shares. Now, even on this, I have a particular topic or I have a particular discussion on this. Let's see what is the discussion out there. Partly paid up shares. This is exactly what I'm talking about. Look at that particular example or illustration given. During accounting year starting from 1st Jan to 31st December, the number of shares outstanding at the beginning of the year is 1800. The number of shares issued during the period are 600, and of 10 rupee nominal value share, only 5 rupees was paid up. The remaining shares at the beginning were complete 10 rupees paid up. Therefore, there is multiple paid up value shares which is arising out here. Let's look at how do I calculate veins in this situation. Now look at it. When did the issue happen? 31st October. How many shares? 600 shares of 5 rupees each paid up. So let's come back to it. Now, if I want equivalent number of shares, and here in this case, I want equivalent number of rupee 10 share because all other shares are 10 rupees each. Equivalent number of rupee 10 shares is equal to 600 shares of 5 rupees each divided by 10, which is nothing but 300. So 300 equivalent number of shares were issued by the enterprise. Now, when did the issue happen? The issue happened exactly on 31st October. So on 1st January to 31st October, for a period of 11 months, because November and December are the only 2 months which are not considered. So for a period of 10 months, 1800 shares were outstanding. After that, for the last 2 months, that is November and December, the actual number of shares outstanding was 2400. But since I'm considering equivalent number of shares, I cannot consider 2400, but I'll have to consider equivalent number of shares. What is your equivalent number of shares? 1800 plus 300. 1800 shares outstanding for the first 10 months. 1800 shares added not by 600 but should be added by equivalent number of shares, that is 300, outstanding for 2 months. Calculate this part. This is 1500. And how much is this? This is 2100 divided by 6 is nothing but 350. So 1850 is my WNES, weighted average number of equity shares in the illustration given to me. So in the illustration given, I'll say that the weighted average number of equity shares is 1850. Clear? That is my first adjustment. Look at my next adjustment to weights. Is regarding change in number of shares without corresponding change in enterprise resources. Why does this occur? Why does this happen that there is a change in number of shares without corresponding change in enterprise resources? Is it necessary always that there is a change in number of shares and there is a change in enterprise resources? I will elaborate. Let me elaborate this part. Let us consider this part. If I have number of shares, and I have enterprise resources. What do you mean by enterprise resources? Enterprise resources is nothing but net assets of the company. It is nothing but net assets, that is assets minus outside liabilities. Look at it. Let's say I have shares issued for cash. What happens? My net assets increases with the cash amount. Correct? Or let's say I have issued it for exchange of asset. Issued for exchange of asset. Again, your net assets will increase. But let's say, for example, I've issued for conversion of a debenture. Issued for conversion of debenture. What will happen when a debenture is converted into equity share? Ultimately, your debenture reduces. There is a reduction in the value of debenture. And when there is a reduction in the value of debenture, which is an outside liability, what happens to your net asset? Net asset increases. When I repay or when I buy back shares, what will happen? When I buy back shares, again my cash will reduce, number of equity shares will reduce. So therefore, you will observe that they are both moving in the same direction. Number of shares increase, net asset also increases. Number of shares increase, net asset increase. Number of shares increase, net asset increase. Therefore, there is always a change in net assets for a change in number of shares. But this peculiar part which I am talking about here, in this given adjustment, I am talking about a change in number of shares without corresponding change in enterprise resources. Why does this occur and where does this come up? I've given you examples. For example, where I've issued fully paid bonus shares. I've issued fully paid bonus shares. So that means free shares have been issued. So what happens? Your net asset did not change, but your number of shares has increased. Share split. For one 10 rupee share, I'm giving 5 2 rupee shares. What will happen? Number of shares increased. Net asset increased? Absolutely no. So this way, I can have situations where there is a change in number of shares without corresponding change in enterprise resources. In such cases, I will assume that such a change has occurred at the beginning of earliest period reported. I will assume that such a change has occurred at the beginning of earliest period reported. I'll tell you what this means. Look at the example given down below. Let's say in the current year, that is in the year 1819, bonus issue came up on 15th of August, Independence Day. A company has declared bonus shares. Now, when the bonus shares have been issued on 15th of August, I will assume that these bonus shares have not been issued starting from 1st April 2018, but I will assume that these shares have been issued at the beginning of 1st April 2017. Why is that so? Because I said such a change is assumed to have occurred at the beginning of earliest period reported. What is earliest period? Then you need to understand that always financials are prepared on a comparative basis. If my current year being reported is 1819, then my previous year reported is 1718, which is the earliest year. Earliest year is 1718. Beginning of earliest year reported is nothing but 1st April 2007. First question, one thing that should pop up is why. First question anyone will ask is why? Why should I do it? I'll tell you why you should do it. Take a particular example, okay? My current year is 2020-21. My comparative previous year was 1920. Okay? Just for the purpose of example, I'm taking. Let's say my PAS, profits available to equity shareholders, last year was 40 lakhs. Current year is 60 lakhs. That means the PAS has actually increased by 50%. Let's say in computation of WNES, I earlier had 20 lakh equity shares. However, during the year, there was a bonus issue. Bonus of 1:2 shares. Therefore, I've issued how many shares? 10 lakh shares. Correct? What is the closing number of equity shares out here? In the current year, the total number of shares will become 30 lakhs. Calculate EPS from this formula. My EPS of previous year is 2, even current year is also 2. If I give you a blind figure that last year EPS 2, current year EPS 2, can you tell me what do you understand from that? I will tell you. What I understand is the company has no increase in earnings. Correct or wrong? Wrong. Because there was a 50% increase in earnings. Then why is it not being represented in your EPS? It is not being represented in my EPS because of this part of bonus shares. So I am saying that these two here are not comparable. Since they are not comparable, to make it comparable, what I will start doing now is I will assume that these bonus shares were issued at the beginning of earliest period reported. What is the beginning of earliest period reported? Earliest period reported is 1920. Beginning is 1st April 2019. These bonus shares were existing right from then. Then what will happen? Restated 1920. How I'll get restated 1920? So I'll get a restated 1920 as 40 lakhs divided by not 20, but I'll consider it as 30 lakhs. Therefore, the EPS here will be 1.33. This 1.33 and this 2 are very much comparable. Now, if I tell you the EPS last year was 1.33 and in the current year has become 2. Therefore, yes, it is an increase of 50% in the EPS figure. There is an increase of 50% in the EPS figure. That is exactly the change as far as your profitability is concerned. Clear? So this is particularly the aspect why I said whenever there is an issue of bonus shares, I'll assume that these bonus shares have been issued at the beginning of earliest period reported. Why did you consider that? If I don't consider it, then my last year EPS and current year EPS are not comparable. Therefore, to make them comparable, last year EPS will be restated, recalculated as if the bonus shares were issued at the beginning of last year itself. Therefore, instead of considering 20 lakh shares in the last year, I've considered the number of shares as 30 lakhs, derived at a comparable EPS of last year as 1.33, which is perfectly comparable to the current EPS of 2. Clear? The last topic is bonus elements in rights issue. What is a bonus element in rights issue? I'll tell you. It is the same logic. The adjustment is absolutely the same. That the bonus shares, whenever they are issued, I'll assume that these shares have been issued at the beginning of earliest period report. There's no change in that logic at all. But what we are trying to say right now is that even in rights issue, there is a bonus element. So I'm not talking about a new adjustment. I'm talking about the same adjustment of bonus shares, where there is an increase in number of shares without corresponding increase in enterprise resources. But someone will say, sir, rights has an exercise price. When there is an exercise price, there is an increase in cash. So enterprise resource has changed. Yes. But I'm not talking about the entire right shares. I'm not saying all the right shares are bonus. I'm saying out of the right share, there is a bonus element, a small element of bonus which is hidden into the right share. Why is that so? Because if the market price per share on today's date is 100, right shares are offered to the existing shareholders. To the existing shareholders, I cannot ask them to subscribe the share at 100 rupees only. I'll have to tell them, I will give you an offer to subscribe the shares not at 100, at 80 itself. Then only they will accept it. Let's say, for example, I'll go like this, okay? I'm just giving you an example, guys. Don't consider that this is the entire thing. Let's say market price per share is 100. My exercise price of rights is 80. Number of right shares are, let's say, about 500. Okay. Now, you tell me how much proceeds did I get from rights issue? My proceeds from rights is equal to 500 right shares, each share issued at 80 rupees. Therefore, my proceeds from rights issue are 40,000. To arrive at the same 40,000 rupees of cash, if the share was issued at a market price, number of shares to be issued at market price is how much? If I would have issued each share at market price of 100 rupees, then in such cases, to arrive at that same 40,000, I would have only issued 400 rights. Sorry, I would have only issued 400 right shares. Correct? But actually, how many right shares did you issue? Actual rights are 500. Therefore, instead of issuing 400 shares at 100 rupees, I issued 500 shares at 80 rupees. Therefore, this 100 excess issue of shares will be considered as bonus element. This is called as bonus element. However, my computation methodology is wrong, but my logic is right. The logic says that to arrive at the same proceeds, to arrive at the same cash, if the share was issued at market price, how many shares would I issue? If I compare it with the actual number of right shares, the actual number of rights are in excess. Such excess will be considered as bonus element. Or I'll put it like this. I'll say that out of 500 right shares, 400 are issued at full consideration, 100 are issued at nil consideration. 100 shares are issued at zero consideration, 400 shares are issued at full consideration. Now, this is exactly what I'm talking about. So, this 100 shares which are issued as bonus element are considered to be issued at the beginning of earliest period reported. They're assumed to have been issued at the beginning of earliest period reported, the same way like we have seen as far as your the second adjustment is concerned. However, computation of bonus element is significantly different. Look at how they calculate. The number of the bonus element in rights issue is equal to number of shares at the beginning of the period multiplied by RAF minus 1. What is RAF? Rights adjusting factor. How do I calculate this RAF? Fair value per share before rights issue divided by theoretical X rights price per share. How do I calculate this theoretical X rights price? Number of shares before rights multiplied by fair value of share before rights plus the amount which I collected from rights issue divided by total number of shares after rights is called as theoretical X rights price. I'll give you an example to help you understand this logic even better. Look at this logic. The rights issue, let's say the net profit was 11 lakhs earlier and 15 lakhs in the current year. Number of shares outstanding before rights issue was 5 lakhs. Number of right shares were 1 lakh shares. 1 share for every 5 shares outstanding. Each right share in the rights was issued at 15 rupees and the last day for exercise of right is on 1st March. That is 2 months in the current year. Right after 2 months in the current year, there's the rights issue. And what is he saying? He's saying that the fair value of each share immediately prior rights issue was 21. So that is the fair value before rights. So let's try to calculate this. What is the number of shares prior rights before my rights issue? The number of shares were 5 lakhs. What is their fair value at that point of time? Fair value prior rights issue was 21. Correct? So I am saying I'll calculate bonus element like this. Bonus element in rights is equal to, how do I calculate? Number of share before rights issue or at the beginning of the year, that is 5 lakhs, multiplied by RAF minus 1. Do you know what is RAF? I don't know yet. What is the formula of RAF then? Come to the formula of RAF. RAF is equal to fair value prior rights issue divided by theoretical X rights price. Theoretical X rights price per share. Calculate. Do you know what is the fair value before rights? Yes, already given in the question, 21. Do you know what is theoretical X rights price? I don't know. So let me calculate theoretical X rights price first. Theoretical X rights price. Theoretical X rights price per share is equal to, calculate, number of shares before rights 5 lakhs into fair value per share 21 plus proceeds from rights. How many right shares did I issue? 1 lakh. What is the price per each right? 15. Divided by total number of shares post rights is 6 lakhs. Solve this. 5 lakhs into 21 is 1 crore 5 lakhs plus 15 lakhs proceeds from rights issue divided by 6 lakhs. There is nothing but 1 crore 20 lakhs divided by 6 lakhs. Therefore, theoretical X rights price is 20. Go to the above formula and submit it. RAF is equal to 21 divided by 20, 1.05. If I substitute RAF as 1.05 minus 1, therefore 0.05 is what is left, multiplied by 5 lakhs is 25,000. How many right shares were issued? 1 lakh. Out of 1 lakh, what is the bonus element? 25,000. So I'll put it like this. Out of 1 lakh right shares, I'll say that 25,000 are issued at nil consideration, that is bonus, and the balance 75,000 will be considered as full consideration, shares issued at full consideration. Now, what is the adjustment on variance regarding? Adjustment of variance is regarding this bonus element. What is the adjustment? Such bonus shares are assumed to have been issued at the beginning of earliest period reported. I will assume that these bonus shares are issued at the beginning of earliest period reported. Let's start looking at it. Computation of EPS. Two years. What are the 2 years given to us? Year 2010 and 2020 and 2021. 2020 and 2021. Calculate what is PAS, calculate WNAS, and you should be arriving at the figure of. Let's look back at the question and place the figures there. What are the figures? 11 lakhs of PAS and 15 lakhs of PAS. WNES we'll have to calculate because we know only that the number of shares outstanding at the beginning are 5 lakhs and there were 1 lakh rights issue on 1st March. So let's consider this 11 lakhs and 15 lakhs. 11 lakhs, 15 lakhs. WNES last year was 5 lakhs. Therefore, actually last year EPS was 2.2. Without considering bonus element, I'll bring in the bonus element. Look at it now. Current year, when I want to calculate WNES, I'll calculate like this. Variance of 2021. Now, instead of taking the number of shares outstanding at the beginning of the year as 5 lakhs, since there is a bonus element, I will consider it as 5,25,000 bonus shares. Until when? 1st March for 2 months. Subsequent to the bonus shares, the number of shares has now become 6 lakhs. For how many months? 10 months. 10 months is nothing but 5 lakhs. This one I'll have to calculate. 525 into 2 by 12. This is 87,500. Therefore, the total number of shares to be considered as gains in 2021 is 5,87,500. So what is the EPS? 15 lakhs divided by 5,87,500 is 2.553. But one thing you need to remember, that these two are not comparable. Why are they not comparable? I'll have to restate the EPS of current year. How do I restate the EPS of current year, of the previous year? Calculate. Restated 2020. 11 lakhs PAES no change, but your WNES will be considered as 5,25,000. So 11 lakh divided by 5,25,000 gonna give me an answer of 2.095. So these two are absolutely comparable. 2.095 will be compared with 2.553 in the current year, and 2.2 is not supposed to be considered for comparative purposes, because the bonus element in the rights issue, that is to the extent of 25,000 shares which we have ascertained here, should be considered as a bonus share which is assumed to be issued at the beginning of earliest period reported. That will bring us to the end of the concept on adjustment to weights.
Subscribe to LearnCab and hit the bell icon to get notified.